Welcome to this market and economic update. In this video, we're going to discuss the volatility that we saw in the market throughout November and what it means to investors as we end this year. Now, major market indices have delivered strong year-to-date returns across stocks, bonds, and even international investments. November brought a period of volatility that affected many of these asset classes, and investors continue to worry about how artificial intelligence, AI-related stocks, and how that path looks going forward with Federal Reserve cuts. At the same time, the government shutdown delayed the publication of key economic data reports, making it more difficult to judge how this economy is really doing. Despite this market volatility, many asset classes stabilized and rebounded at the end of the month. And over the next few minutes, we're going to walk through what investors should keep in mind. November saw investors temporarily move away from risky assets such as tech stocks, high-yield bonds, and cryptocurrencies. This was primarily due to questions around the sustainability of AI and investors adjusting their expectations around the Federal Reserve cutting their rates. AI tech stocks experienced the worst week since April. Concerns around spending limits, profit margins, and questions around a potential bubble really created that volatility. Yet beneath this, many fundamentals remain strong, with companies such as Nvidia reporting healthy revenue growth and earnings growth for the third quarter. Now, cryptocurrencies experienced a sharp correction during this risk-off period. Bitcoin fell over 30% from its early October highs, briefly even trading below $85,000 a coin. While this adoption of cryptocurrencies by investors has grown, periods such as these demonstrate that these assets can be highly speculative and prone to boom and bust cycles. Now, this chart that we have right here below us, it shows the S&P 500 has experienced 6 pullbacks of 5% or worse this year. While this is the worst since 2022, it's not far from the historical average. For investors, this is a reminder that brief periods of market uncertainty are completely normal. I decided to stay up here for this one as well. Shifting to the economic data, the longest government shutdown in history ended after 43 days, but the federal government will only be fully funded through the end of January of 2026. This means that political uncertainty will continue to be a source of investor concerns. For investors, the bigger challenge is that the shutdown delayed some key economic data. For example, the delayed September jobs report showed the economy added 119,000 new jobs, and the unemployment rate ticked higher to 4.4%, its highest level that we've seen since October of 2021. Although still low by historical standards, a full October jobs report would not be published and surveys were not conducted during that month. This lack of data makes it more difficult to understand exactly how the economy is performing from a fundamental analysis perspective. Hey, I came back down here. Okay, now in particular, the impacts of the Federal Reserve since they will enter their mid-December meeting without the full economic picture. Expectations for a rate cut at the next Fed funds meeting have shifted wildly, with market-based expectations now suggesting the Fed will cut rates in December and then again in April or June of 2026. Still, November's market volatility, ongoing uncertainty are reminders that swings in the stock market are normal. For long-term investors, this underscores the importance of maintaining an appropriate portfolio that can navigate the ups and downs of the market. We hope you found these insights helpful. If you would like to discuss any of these topics, including how your asset allocation looks going into the new year ahead, please don't hesitate to reach out. We look forward to speaking with you. And if we don't hear from you, just have a wonderful Merry Christmas, enjoy time with your family, and let's get together early in the next year. Thank you so much.